welcome to Money, Money, Money. I'm Samira Abdi and welcome to a brand new year as well. Here's wishing all our viewers the very best and most of everything in 2016. Well, 2015 has seen its shares of ups and downs, hits and misses. Will 2016 be any different? Should you brace your portfolio for some more shocks, or will it be smooth sailing here onwards? More importantly, what are the lessons from the year gone by and how can they help you shape a financially secure future? Well, those are just some of the questions that we'll be posing to our first guest of the year, one of the best money managers in India, Nilesh Shah, MD, Kotak Mutual Fund. And you wonder why I say we? Well, that's because joining me is also someone else, and that's none other than Latha Venkatesh. So thanks very much to both of you for being on Money, 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 the first show of the year. And a very happy new year, Nilesh, and a very happy new year to you as well, Latha. But I want first both your thoughts on how 2015 was, and therefore, what are the lessons for 2016? I mean, what do we hope for in 2016? You want to go first?
As a host, yes. First, Happy New Year to you and welcome, Nilesh, and thank you for inviting me, Samira. Well, actually, 2015, when we began, was a year of great hope. And we did touch 9,000 on the Sensex and on the Nifty and 30,000 on the Sensex for a brief few moments. But thereafter, the euphoria petered out. So actually, for an investor, especially in mutual funds, the year was bad only in comparison to the early promise. Otherwise, if you end the year flat, well, at least you're not lost in terms of capital. So for me, the big lessons were, one, that you always think that if you stuck with the Nifty ETFs and then don't bother about it, you will make money. It was not quite that year when the Nifty gave money. The second lesson was that those who did assiduous, hard work, stock picking, actually did better. So, for a mutual fund investor, is it that we have to go around doing some research? Is mutual fund not lazy investing or, invest and forget it kind of investing? These are the questions that come to the mind, and I think you've got the right guest for that.
Yeah, it's a time to be more active. Nilesh, as a fund manager, what are the lessons you'd say that you've learned from 2015, and therefore how's 2016 looking?
Or lessons that we ought to learn.
So as a fund manager, we realized that India is far more globalized than what we had earlier thought. Second, the resilience of India notwithstanding, it is important to look at the foreign perception about India. We may believe that we have created companies like Maruti, which are today valued at more than their parent Suzuki, despite not owning anything in Suzuki, whereas Suzuki in some sense takes 53% of Maruti. But the marketing to the foreigners in terms of resilience of India is as critical. Third, this is a year where you could have made money if you were stock pickers rather than sector pickers. Our mid-cap funds are up 12-15% a year where markets are negative. Even our multi-cap funds are up positively in line with fixed income funds on a post-tax basis. So this was the year of not lazy investing, but selective investing. People who invested on their own without listening to probably an advisor ended up not getting as much return as people who listened to their advisors and then invested.
You know, I've got the list of equity funds. And here you have performance as low as minus 0.4 and actually as high as 23-24%. So, obviously the ones that have not done too well have been those which are large cap oriented funds or Sensex Nifty oriented funds. And those who have done exceptionally well are the micro cap funds or the small and mid cap funds. Now, first a generic question. Because the large caps have been such underperformers and because the mid caps have done so well, would next year be return of value to the large caps, and do mid caps look overvalued?
So certain parts of mid cap do look overvalued, but then in September 15 quarterly results, we have seen companies across various sectors delivering 30% YOY growth on free cash flow. From a valuation point of view, that segment doesn't look attractive. So 2016 in some sense will be similar to 2015 in terms of stock picking. It's your ability to pick up stocks which will deliver return.
A lot of people have been telling us over 2015 that they've actually made money by shorting the market. Now, this is something which confuses the small guys. The small retail investors don't understand this. They don't know how to even go about it. And therefore, a lot of the investors who've been coming on our show have been telling us that we're looking to actually redeem our mutual fund because it's not giving us any return. What's your advice, or what's the case to be made for people like this to actually remain invested even though the returns may not be forthcoming immediately?
So let me go to the cricket methodology. There are batsmen who can do reverse sweep. How many batsmen are capable of doing it? The investor must ask the question, are you like Mike Getting, who tried hitting a reverse sweep and lost the World Cup? Don't be Mike Getting. A reverse sweep is a risky shot. It can only be played after you have practiced it to the perfection. The second thing, people are talking about that, look, in mutual funds I haven't made money. But you have invested for 1 year, then equity was not the right place. If you invested again on a lump sum basis, then my dear friend, you have made an error. You have to do SIP. You have to invest with 5 to 10 year horizon.
Okay, but one thing I want to ask you is that a lot of people, a lot of financial advisors, as you're saying, have been recommending actively managed funds, especially in years like this, right? Therefore, as a fund manager, why don't you tell our audience or our viewers or potential investors, what is the one question that they should be asking that fund manager? I mean, if someone were to ask you, what is the one question they actually need to ask?
So, one question which I have always wanted people to ask me, but yet no one has asked me, is one, how much should I invest in equity and for how long? Every time people ask me, what should I buy? My dear friend, how does it matter to you? I am no astrologer. I have no ability to make you rich. But if you ask me questions, how much should I buy in equity and for how long? I think that's the key to making money.
Okay, all right. What should an ideal mix be? Should one, do you think that investors should be putting in 50% of their money in micro and small cap, or 40% of their money? How much in large, how much in mid and micro cap fund, how much in balanced, how much in fixed?
Now within equity, I think it's time to be overweight multi-cap funds, where the fund managers can decide how much to invest in large cap and how much to in mid and small cap. The second segment will be SIP in small cap and micro cap funds, because there the volatility then will work in your favor. In the fixed income space, we believe credit accrual funds will do better than duration fund because the carry is fairly high. In gold and precious metal, I think it's important to buy gold bonds rather than physical gold, because you get the benefit of price appreciation plus you get a coupon income. In real estate, be very, very choosy. If at all you have to invest, try to invest in affordable housing rather than luxurious segment.
Okay, so one of the big takeaways that I'm getting from what both of you are talking is that it's really the fund manager and their ability which is going to define how your investments are going to be shaped. Therefore, one question that's pertinent to you is, you moved recently from Axis to Kotak, right? A lot of people say follow your fund managers. Do you think is that what a lot of people should? I mean, my tendency would have been to follow.
No. I mean, if an organization is person dependent, there's something wrong with the person or there's something wrong with the organization. One person cannot build an organization, neither can kill the organization. And today, without any doubt, I can say in all my peers, we have all initiated processes which is independent of person. It's the team which wins, not the captain. Captain only gets the recognition.
Well, that's very modest of you. Alright, on that note, let's take a very quick break. We'll come back in just a bit. We'll make a fair assessment of 2014, and we've done a little bit about what to look forward to in 2016. So we'll do a lot more. Will fixed income actually prevail? What about gold, silver? We've spoken a little bit about all of that, but we'll tell you what else to look forward to in 2016 in just a bit. Stay tuned.